this particular international equity fund facilitated by, again, one of the pension providers on the market, you've average returns there of about 7.5% per annum. So it does work, but you just have to be wary of and careful of these peaks and troughs along the way. A couple of basic facts about Greece then. None of this is going to come as a surprise to you. This is a chart from 2012. And in terms of government debt as a percentage of GDP, you can see at the time, really in terms of countries that are worth talking about, only Japan had a higher debt to GDP ratio than Greece, and that was as far back as 2012, and that hasn't gotten any prettier in the meantime either. A couple of other points about Greece, and I'm picking this information, I suppose, in terms of what's been bandied about the media. One issue would have been the level of tax collection in Greece. So we can see here on the far left, the title of the slide, the level of the shadow economy in OECD countries in 2015. So we can see that almost a quarter of, let's say, the economic activity in Greece is under the radar. And if economic activity is under the radar, then you have income that's not being reported and subsequently income that's not being taxed. So Greece is right up there in terms of the size of the shadow economy compared to, for example, Germany right in the middle of the slide, coming in at about 12% odd. So there is definitely an issue in that respect. Ireland, curiously enough, is only about 3 notches lower than Germany, so possibly, hopefully, we have improved over the last couple of years. Another issue in terms of Greece, there's a lot of talk about pensions in Greece, and as to whether, I suppose, the level of pensions paid is too high. One interesting statistic here is the old age dependency ratio per 100 persons, and it's effectively saying that Greece has about 31 persons dependent on state pension for every 100 people of working age, which is quite high. Now, there are higher. You have Italy there, and Germany is not far behind Greece either, but again, it's up towards the higher end of the scale. Interestingly enough, that will be an issue which will impact us all. In terms of most European countries, the graph is going that way as birth rates fall and people live longer. So you boil a lot of issues down and Greece is running out of money. And this was up in terms of billions of euros on deposit in Greece, started to fall off a cliff towards the end of 2014, and this chart is up until February, and if we are to believe what we are being told, Greece will run out of cash anytime over the next few days, possibly a week. So it's all about Greece for the Greeks, and the simple fix for a lot of this is some big Greek write-down. But really, no surprise if anybody who's been tuned into these discussions and reading various media reports. Really, the issue for the rest of Europe is, well, look, if Greece look for and succeed in getting some kind of a debt write-down, well, will Ireland, Italy, Portugal, and so on also be teeing up for debt write-downs then as well? So that's kind of where they're stuck at the moment. So what does this mean for pension funds? Any pension fund is basically made up of the same asset classes or building blocks to a greater or lesser extent. So the building blocks of pension funds are cash deposit, then you're into government bonds, corporate bonds, property, equities, which is stocks and shares, commodities, precious metals, currency, and so on and so on. So any pension fund is either one or an amalgamation of a lot of those different types of asset class. And there's a constant battle within these asset classes between the concept of a bull and a bear market. A bear market effectively is where prices are consistently falling, a bull market being where prices are consistently rising. And as per the pictures on your screen, you don't really want to be on the wrong end of either a bull or a bear market. Coming back to pension funds, and we'll get to Greece again in a second, but I'm just trying to put all this into a little bit of context. Coming back to pension funds, different types of pension funds. So if we're looking at our cash funds or bond funds or equity funds, there is a European-wide risk rating, which was brought in about 3 or 4 years ago, to give investors some semblance of what can be expected from a particular pension fund. And the risk rating system works on a 1 to 7 scale. So as you would imagine, somebody with a pension fund which is all invested in cash would have a risk rating of 1. So they're not going to make more than 1 or 2% per annum, but you would reasonably expect that they're not going to lose more than 1 or 2% on an annual basis either. Right up to, let's say, risk rating of 7, which would be an example of a risk-rated 7 pension fund would be a pension fund that was invested in emerging market equities, which are, your South Americas and certain parts of Asia and so on. So the sky is the limit. You could make a killing, 25, 30, 40%, but you might also lose your shirt as well. And one of the issues over the past maybe 2 years is that because cash returns on pension funds and returns on cash in general has been so low, that people, in order to achieve some kind of yield on their pensions, were forced to climb the risk scale to try and make something, because in reality you need about 3% per annum on your pension fund just to stand still, once you factor in maybe pension fees and charges and a little bit of inflation as well. The basic rule of any investing, especially in pensions, is and always has been, don't have all your eggs in one basket. I know it sounds a little bit cliche and simple, but it's the truth. That you spread your risk across different asset classes with the goal, with the aim that all asset classes don't behave in the same way at the same time. For example, these are two different pension funds run by an insurance company, Friends First in this case, just happened to pick those at random. The blue line is their currency fund. So it's a fund that effectively takes a bet and a stance on the direction of various currencies in relation to another currency. So, will the euro fall against the dollar or rise against the dollar? Will the dollar fall against the yen, and so on and so on. So if you look at that blue line, back in 2008, stays above water when an international equity fund, so stocks and shares fund, in 2008, 2009 fell by about 45%. So the point of this chart, and it's relevant in the Greek context, is that if you diversify and have different types of assets in your pension fund, you can insulate yourself against particular market events. So we can see that these two particular funds behaved largely in different ways at different times, all to the extent that if you look at where I have the circle around 2014 odd, the currency fund started to fall and the equity fund continued to rise. And that's what you would expect, and that's what you should have in any kind of a diversified portfolio, is to have different asset classes that behave in different ways at different times. Now, to give me a little bit of a break, and just so I can get a sense of people's knowledge out there, I am going to launch a poll question. And the poll question is quite simple. Do you understand your exposure to the Greek crisis? I'm just trying to get a gauge of how confident people are in terms of how their pensions may or may not be affected by what's happening out in Greece. And I will give it another 5 or 6 seconds just to see how people are feeling. And it's largely coming in as I would expect. About 2/3 of people seem to be pretty uncertain as to what effect the whole Greek crisis might have on their pensions. I'm just going to share the results with you now. So about 2/3, 1/3 split, which again wouldn't really surprise me. But if any of you are lucky out there to have 100,000, hundreds of thousands, really it's something that needs to be figured out. And we'll start having a look at it now in a second. Back to the presentation. So based on the premise that diversification is a good thing, what is true diversification in the Greek context? So this is a fictitious pension portfolio. So somebody says to me, look, my pension is very well diversified. I've 335,000 there in total. I've 25,000 in cash. I have some government bonds. I've corporate bonds. I've a little bit of property in there. I've equities. I don't really like commodities or precious metals. Don't really understand currency. But look, all in all, it's not perfect, but it's a fairly well diversified pension fund. This is my point. Is it really? So you could very well have, and I have no idea because everybody has a different pension portfolio, but let's look at an extreme just to illustrate a point. You could have your cash and deposit all in euros. You could, your government bonds and your corporate bonds, which are another asset class, could be European government bonds and European corporate bonds. Your property could be continental European property. Your equities could be largely all euro equities, and so on and so on. So even though you have a diversified portfolio, it might actually be quite narrow in its focus and leave you very exposed to what's happening in Europe, i.e. what's happening in Greece. So is it possible to diversify something even further as a fix? Well, predominantly the same portfolio, 355,000, as you will see on your screen again. And I've changed it a little bit in terms of I've lessened the equity content and increased the precious metals and commodities and a little bit of currency, just to give it a bit more balance. But in terms of region, well, let's say our cash holding was in sterling. And let's say our government bonds were world bonds and UK bonds, and let's say our corporate bonds were equally spread out amongst the world, and let's say our property was Irish and UK property, and so on and so on and so on. So we had much less focus on Europe, and we were casting a much wider net. Would it have made a difference? I picked 1 week. I think these dates I picked were the day, I think, or the day after that Greece announced it was going to have a referendum for the next, and I tracked a construction of funds for the next 5 or 6 days. So our construction of funds that we saw previously, which was very well diversified, but it was all focused on Europe. This is what happened to it over the course of those few days. It was down about minus 1.33%. One of the interesting facts about what's happening in Greece at the moment is that whilst there has been falls in stock markets and bond markets, it by no stretch has it been as horrific as some people had thought. It seems to be still quite measured and quite calm. And the second slide you have there is our very well diversified pot again. But it's this is the approach where we have all our bonds and our equities and our property, but we've cast a much wider net in terms of the types of pension funds we're exposed to, where there's more of a world focus and less of a European focus. And over the same time period, we're up about plus 0.64 odd percent. Now it's not huge, it's only a little shy of 2%, but it's 2% over the course of a week. Now, what happens in 1 week is never going to be replicated exactly for the next few weeks. But just entertain my thought process on this for a couple of minutes. Let's say it did, and okay, let's accept the fact that there is going to be a difference. And for the purposes of illustration, let's say that difference is the same each and every week. Well, the first European-focused pension portfolio loses about 15,500 or is down a little shy of 8% over a 6-week period. The worldwide focused pension portfolio based on these set of assumptions is up about 7,800, so it's up about a little shy of 4%. So you have a 23,000 difference there, which is about 11%. Now I'm not saying by any stretch that that's the way it's going to go, but I'm just trying to make the point is you can't escape what's happening out in Greece. What you can do is just spread a nice wide net, invest in a lot of different asset classes, assets that behave in different ways at different times, and with as large a worldwide focus as you can possibly get, which is what we strive to do here for our own clients, and we're pretty confident that we are getting it right. If you did make a loss, be it the Greek crisis or any other crisis, what I have here is it's a little bit windy here, but if you're looking at the green boxes, so if you had a pension worth 385,000 and after a market event and there was a big loss, it fell to 225,000, which is kind of what happened to a lot of pension funds or poorly diversified pension funds back in 2008, 2009. So you have a 41% loss. To make up that 41% loss, you're looking at a recovery needed of 71% of your 225,000 because you're working off a lower base. And if you were trying to make that up over, let's say, a 5 or 6 year period, which would be the intention, you're looking for growth rates of 11% plus per annum. So, you know, that means that in order to recover the loss, you have to take an awful lot of risk to try and recover your loss. So you know, and on the basis that there's a market event every 6, 7, 8, 9 years, you know, in some cases you've no sooner recovered your loss, then there's another big event and you're back to square one again. So the impact of one big loss, you could be chasing it for many years to come. So what can be done to reduce it? Our volatility, and the volatility at the moment just happens to be related to the Greek crisis. The first thing you need to do is identify what funds you're in and what the risk rating is. You need to diversify your asset types, also by geographic exposure and not just the asset type. Your ability to withstand financial loss and the time you can afford to recover the loss will guide your investment calls. So if you have 20 years to go to retirement, well, you know, if you make a loss of 20 or 25%, while it's not ideal, it's not the end of the world either. But if you're in your mid-60s and you're planning on drawing down a pension in a couple of years' time, well, you just can't afford to make those kinds of losses. So you should pick risk-appropriate funds and alter your fund selection depending on market conditions. One example of this that we use here, and my existing client base who are on the webinar this afternoon will be aware of this, is that I have been recommending by means of diversification and trying to get assets that might not behave in the same way as financial markets at the moment, is getting involved for probably a small period of time, maybe 6 or 12 months, into Irish property funds, which have been doing quite well. You would expect them to do relatively well for the next few months, and they should behave in a different way to the whole Greek crisis, and have been doing so for the last 6 odd months. So it's little items like that that can make all the difference. Advice when you start a pension needs to be backed up with ongoing regular advice. The amount of people I come across who have pensions, and I just had a meeting 45 minutes ago with a lady who had big pension fund in relative terms, but didn't really understand how it was invested, was getting no regular advice. So it really you are entitled to at least 1 hour of whoever your financial advisor's time, whoever your financial advisor is, at least once per annum, if not more. And if you are very concerned, there are capital protected funds whereby you can invest in, for example, the stock market with a protection of the capital. Now, you know, you mightn't do as well as somebody who is not taking the capital protection. But if you're kind of in retirement or close to retirement, maybe that might be another option. So there are lots of things that can be done, but the starting point is to understand what exactly are you invested in. So first step is you just need to know how you are invested and take advice. And if you're not getting the advice, you need to find somebody who is going to give you that kind of advice. We have an offer, a shameless offer as usual. We will review your pension funds. So anybody who has concerns on the back of the webinar here this evening, i.e. those who I suppose don't really seem to understand what the extent of their exposure might actually be. We have an offer whereby if you get in contact with us, we will have a look at what you have and give you our analysis of what you may or may not have in place. You can contact me directly, mcoburn@rda.ie, or down the Wexford office here, 053 917 0507. And you will also have, I understand, the option to request a call once you exit the webinar. I think there is an option to tick a box and request a call. I think I'm bang on about 30 minutes. I won't take up any more of your time. Thank you so much for listening. And we hopefully will be in touch, and we will run regular webinars throughout the course of the year. And I would encourage you all to contact me if you have any concerns. Thank you so much. Bye-bye.